So the next one is the final component of tax expense is your deferred tax expense. So deferred tax expense is simply this. You take your opening net deferred tax asset and liabilities, take your closing net deferred tax asset and liabilities, the change from opening to closing, if you take out the equity accounted entries, and we'll look at what that is, that change from opening to closing is your deferred tax expense. So to work out your deferred tax expense, you need to calculate your deferred tax asset and liability balances. So the next, what we're going to do is discuss the calculations of deferred tax assets and liabilities. So in order to calculate your DTAs and DTLs, you start with your trial balance. Your trial balance will contain the carrying amount of your assets and liabilities. For each asset and liability, you need to compare it to their tax base, and the difference will give you the temporary difference. So the carrying amount is whatever you have in your trial balance, the book value or accounting value. Now, you know that you need to put through all your accounting standard changes. For example, putting through your right of use asset additions, and you need to put through any impairments or revaluations before you do your tax calculations. So tax is the final adjustment. You then need to calculate the tax base of each asset and liability. So broadly speaking, the tax base of the asset and liability should broadly reflect your understanding of what their values are for tax purposes. So let's have a look at that, and I'll come back to CGT asset because it's slightly different. If you have a depreciating asset, your plant and equipment like your computers and your furniture, the tax base should equal the tax written down values of those assets and liabilities. For trading stock, it will be the tax value for tax purposes. Broadly, it will be the tax cost of your inventories. For liabilities, it depends on whether or not when you pay that liability, it will give rise to a deduction. So, for example, if you repay a bank loan, a trade creditor, or an intercompany loan, the payment of that liability does not give rise to a deduction. So in that scenario, the tax base of that liability will equal the carrying amount. So no different from what you have in your trial balance. Now, certain liabilities, you get a deduction when you pay it out. For example, an annual leave provision or a superannuation accrual or audit fee accrual. In that situation, the tax base of that liability would be 0. Now, I'll come back to the tax base of a CGT asset because it depends on whether you are holding the asset for use. That means you're using it to generate sales or services income, or you're holding an asset for sale. Now, the two common areas that could give rise to errors, one is intangibles. So let's say you acquire trademarks or brand names or customer contracts or customer relationships. Those assets are generally regarded as being held for use to generate sales income. So when you're holding an asset for use, the tax base will equal the future depreciation that you are going to get on those assets. So things like trademarks, brand names, copyrights, customer contracts, they are not depreciable for tax purposes. So there'll be no depreciation allowed when you use those assets. So their tax base would be 0. The same with buildings as well. If you have a building and you are depreciating that building for accounting purposes, there is a rebuttable presumption that the asset will be held for use. That means the tax base will equal the future Division 43 deductions that you're going to get from that building. Now, if you have something like land, for example, it may be regarded as being held for sale. So in that case, the tax base should equal the cost base because you can deduct the cost base against the sales proceeds there. So that's something to be careful of. when determining the tax base of GGT assets. Now, if you like, you can use these formulas here to calculate the tax base of your assets and liabilities. For the tax base of an asset, you start with the carrying amount, and then you minus the future assessable amount from the use or sale of that asset. And WSB 112 says the future assessable amount will always equal the carrying amount. So you can make that assumption. And then you add the future deduction that you'll get from those assets. For the tax base of the liability, you start with whatever you have on your trial balance, and then you subtract the future deduction that you're going to get when you pay out that liability. And you can also see calculations, the formulas for prepaid expenses and prepaid income.